Do you follow the herd? Nicholas was starting to notice certain facts about the stock market. Fact is that industries move up and down to some degree independently of the stock market averages. Prices herd within industry groups. But the average price for the group moves up. So does the individual stock price. If the average price for the group moves up, so does the individual stock price. He filtered his stock selections by identifying the strongest rising industry groups. Be careful about reading too much into this. Industry rotation is not a valid approach to momentum investing. You're far better off to simply identify the most powerful stocks in the broad market of 6,731 firms currently listed on the New York Stock Exchange, American Stock Exchange, and NASDAQ exchanges. I select the 50 strongest from a group of 2,995 core stocks across these three exchanges every quarter. I put all these eggs in one basket and I watch them. I test the strongest. I may go up to a year without making a single test. I trade very infrequently. Stocks have personalities. These were invariably rising because earnings were strong in that industry. Then once he identified the strongest earning industry, he would drill down to identify the strongest rising stock in that industry. Darvas decided that individual stocks had personalities within their industry, just like different children in a human family. If Nicholas was studying market data for General Motors, he would automatically extend his analysis to that industry. Studebaker. In the 1950s, the automotive industry to which General Motors belonged was comprised of Chrysler, Studebaker, and American Motors. Alcoa Aluminum is another company. Tin foil is used in nearly every kitchen in America. Kaiser Aluminum was a big industry player in the 1950s, but Kaiser had competitors in its industry. These included Alcoa and Reynolds Metals. You know Reynolds Wrap, I'm sure. Moving forward with the methodology made him feel grand. Nicholas knew that he was finally going beyond hypothetical thinking. He knew he was going to make a lot of money. Darvas looked hard at average industry earnings. This allowed him to compare industries by profitability. Darvas falls in love with steel. The steel industry stood out as the most profitable. This was during the post-World War II Korean War era. He found that his top rating was so exclusive that it excessively limited his stocks. He lowered the rating to a second tier of B that he was willing to consult. This dramatically increased the amount of possible stock investments. By combining industry profitability and rating, he was able to identify Jones Laughlin. The company paid a fat 5% dividend of 1.25% quarterly. The price to earnings ratios were the lowest, which is the best as well. Notice that Jones Laughlin had a PE ratio of 5.4. This was lower than the PE ratio of 7.9 for Bethlehem Steel, 8.3 for Inland Steel, 8.4 for U.S. Steel, or 8.5 for Republic Steel. Analysis excited him. It filled him with confidence that the stock share price would rise. It would make him rich, he believed. He was convinced that the stock would jump $20 or $30 in a heartbeat. He felt that this was a better bet than Breland. There was just one concern. He had to buy a lot of it as fast as he could before anybody else discovered the stock, or at least so he felt. Nicholas Darvas was a worldwide entertainer. He was also an act in Nevada. Over the years, he acquired a home in Las Vegas. He took out a second mortgage on the home. He also had a whole life insurance policy against which he took a loan. Then he got an advance on a long-term contract to dance. This dangerous dash for cash was fueled by the overconfidence of Nicholas Darvas. As a professor of finance, I do not recommend that you do this. You're far better off to save at least 15% of your salary for retirement every single month, in and out. And that is easy to do if you're a salaried employee. Overconfident investors have been shown to ride losing positions in favor of winners by UC Berkeley professor Terence O'Dean. Shows before the Strip were quite a bit different. Women dressed like this. Darvas was an entertainer. That meant that he worked from contract to contract, and he felt very confident about his analysis. He did not hesitate in finding seed capital for his stock investing. Then on September 23rd of 1955, Nicholas Darvas bought 1,000 shares of common stock in Jones Laughlin. He bought at 52 1/4 on 70% margin. The stock price drops. This allowed Nicholas Darvas to own $52,652.30 of stock for $36,856.61 from the money he raised all the wrong ways. But he was capitalized. He sat back to watch it rise, but the stock dropped. I want to emphasize at this point that I've experienced this phenomenon so much that I'm very slow to test stocks. As time passes, I've grown more experienced and have become much more selective, as did Darvas. This crisis shocks Nicholas Darvas as much as it did the first time it happened to me. As Jones and Laughlin collapsed, he froze like a deer in the headlights. He would not embrace the evidence that his prior hypothesis of strength was wrong. He firmly believed that the stock that had been in the 50s was truly worth $75 a share. He held and held until the stock hit 44 on a downslide into the 10th of October of 1955. Every dollar drop in share price was costing him $1,000. He sold in terror. His account balance now stood at $43,583.12. He lost $9,060.18 while he stalled. This was a crushing blow to his ego. His confidence in his method was shaken. This type of psychological pain was impossible for anybody to understand who has never placed a significant percentage of their wealth on the line. This was not an indexed investment with high diversification. Nicholas Darvas had put all of his wealth on one big bet on just one stock. But he did not feel like a gambler. Darvas had invested significant effort in the stock analysis, but he was down $9,000 despite his hard work. This is consistent with academic fact. Benjamin Graham is the Columbia finance professor who taught Warren Buffett value investing. He explained in a 1976 conference covered in the Financial Analyst Journal, "I am no longer an advocate of elaborate techniques of security analysis in order to find superior value opportunities. This was a rewarding activity, say 40 years ago when our textbook Graham and Dodd was first published. But the situation has changed a good deal since then. In the old days, any well-trained security analyst could do a professional job of selecting undervalued issues through detailed studies. But in the light of the enormous amount of research now being carried on, I doubt whether in most cases such extensive efforts will generate sufficiently superior selections to justify their costs. To that very limited extent, I'm on the efficient market side of thought, now generally accepted by the professors." Depression hit when he fully understood that he could lose his home in sunny Las Vegas. He felt like an inmate trapped by his own futile results, as if he was reaching out from a jail cell. He was desperate to find a rising stock that could break him out of his own self-made debtor prison. Nicholas spotted a company called Texas Gulf Producing. The stock price was higher the day Darvas spotted it than months before. The share price had been rising. He couldn't find any rumors about the company. He didn't know the profitability. The only thing he knew was that it was posting share price gains week after week. He bought the stock in desperation. His order for 1,000 shares was filled between 37 1/8 and 37 1/2. The total investment was $37,580.26. But this time, he was not so sure that the stock would rise. He held his breath. Now he was gun-shy from his recent loss. This caused another problem. After the stock had risen $2.50, he became anxious to sell out at $40 per share. But he hung on to the position with determination to earn back his $9,000 loss. He worried intensely about the position for fear that he was wrong again. But this time he resisted his temptation to earn fast cash by flipping the stock. His nervousness created another problem. He pecked at his broker constantly, calling hourly, or even more frequently. He babied the stock like a child. He strapped himself to the mast and held shares for a full 5 weeks. He was tense each day. Nicholas finally sold out at 43 1/4. His account balance stood at $42,840.43. Darvas did not recover his $9,000 loss, but he recovered the lion's share of $5,254.17. The Texas Gulf Producing trade drained him like a disease. He had to rest and recover. Even as Columbia professor Benjamin Graham questioned the worth of detailed financial study in the form of reports, outlooks, ratings, and ratios, Nicholas was now concluding the same. The one stock that saved his investing account was the company he knew the least. The only thing Nicholas Darvas knew about this stock was simply that it was rising.